Welcome to the deep dive. We're here to cut through the noise, all those headlines flashing by. What's the real story when a big energy player like Enterprise Products Partners announces its results?
Exactly. We dig into the source material, the earnings calls, the press releases to give you the actual insights. No spin, just the core information.
So you get the important stuff without wading through everything.
Precisely. And today we are diving deep into Enterprise Products Partners, or EPD. Their second quarter 2025 earnings just came out. They're a huge player in North American midstream energy.
Right, the pipelines, the processing plants, the infrastructure that keeps energy moving.
That's the one. Our info today, straight from their official earnings call and their detailed press release, fresh data.
Okay, so our mission is clear. Unpack how EPD performed, what challenges they hit, their strategy going forward. Let's get into it.
So, big picture first. They're calling it a good performance for the quarter, which is, frankly, pretty impressive considering they also mentioned facing considerable headwinds.
Considerable headwinds. Okay, that jumps out. What exactly were they up against? I mean, how do you pull off good performance with that going on?
Well, the sources mention a few things: seasonal factors, shifts in the wider economy, macroeconomic stuff, and even geopolitical pressures impacting energy markets.
Wow, okay. So mix of challenges.
Yeah, kind of a perfect storm scenario almost. But despite that, their financials held up remarkably well, really robust.
That is impressive. So let's talk numbers. How did Enterprise actually do? What are the key metrics telling us?
Okay, so for Q2 2025, adjusted EBITDA, that's a key profitability measure, earnings before interest, taxes, depreciation, amortization, it landed at a solid $2.4 billion.
Okay, $2.4 billion. Strong number.
Very strong. And what's really interesting, I think, is their distributable cash flow, the DCF. That's the cash they actually have available to, pay investors or reinvest. That actually increased 7% compared to last year, hit $1.9 billion.
A 7% increase.
In this environment. Yep. And that gave them really strong coverage for their distribution, 1.6 times coverage. Plus, they retained almost $748 million to be exact of that DCF.
Okay, so they're making good money, growing the cash available, and holding on to a decent chunk for the future. That feels like solid management. What about net income? CFFO.
Net income for common unit holders was $1.4 billion, basically flat with last year, but earnings per unit actually ticked up 3% to $0 Series. And adjusted cash flow from operations adjusted CFFO, basically cash from their core business, that held steady too at $2.1 billion. Really solid.
And for listeners, especially investors, the distribution is always key.
Right. They declared 0.545 per common unit. That's up 3.8% from Q2 last year, payable mid-August. But here's where it gets really interesting from an operational standpoint. They set 5 new records, volumetric records.
5 new records.
Yeah.
With all those headwinds. Okay, that is surprising. What kind of volumes are we talking about here?
Yeah, it really highlights their physical dominance. They processed a record 7.8 billion cubic feet of natural gas per day. Their gas pipelines moved 20 trillion BTUs British thermal units per day. Another record. They transported over 1 million barrels a day of refined products and petrochemicals, new high, and record crude oil pipeline volumes too, 2.6 million barrels per day.
That's just a staggering amount of energy moving through one company's system. What does that tell you about demand?
It says demand for their specific services, using their pipes and facilities, is incredibly strong. Their assets are clearly critical and running hard. And it wasn't just oil and gas. NGL's natural gas liquids, their pipeline volumes were up 5% to 4.6 million barrels a day. And in the Permian specifically, gas gathering saw a big jump too, 1.0 TBT per day increase.
So it sounds like despite the market wobbles, the physical need for their infrastructure is just growing and growing. They're running flat out.
That's a great way to put it. They're maximizing their assets.
Okay, so performing well now, navigating the storms.
Yeah.
But what about the future? Growth. What's in the pipeline, literally and figuratively?
Yeah, good one. They are definitely looking ahead. They've got almost 6 billion with a B in organic growth projects scheduled to start up over the next 18 months.
6 billion. That's a huge commitment. Where's that money going?
A big chunk, nearly half actually, about $2.8 billion, is set to come online just in the second half of this year, 2025.
Okay, so a lot happening soon. Where are the big focus areas?
The Permian Basin remains absolutely central. They're expanding their natural gas processing there significantly. 2 new plants, Mentone West 1 and Orion, are ramping up right now. And a third one is slated for early 2026.
Okay, 3 new plants in the Permian. What kind of capacity does that add? That basin is still booming.
Oh, yeah. These three plants together, they'll push Enterprise's total Permian processing capacity close to 5 BCF a day, that's billion cubic feet, and capable of producing about 650,000 barrels per day of liquids.
Huge numbers.
Yeah.
And how quickly are these plants filling up? Is the demand really there?
That's the kicker. They mentioned these plants are ramping up super fast, already around 90% utilization in the Delaware and Midland basins. And they expect them to be completely full by the end of the year.
90% already. Wow. That tells you the market desperately needed that capacity. Suggests pretty immediate returns, too.
Absolutely. It translates directly into revenue. Okay, so beyond gas processing, what else? There's the Neches River Terminal, NRT, big new export facility on the Texas coast.
Exports.
Yeah.
Crucial these days.
For sure. Phase 1 just started up mid-July. It gives them 120,000 barrels per day of ethane loading capacity, primarily for international markets. Then Phase 2, that's expected first half of 2026, adds what they call a flex train.
Flex train. What does that do?
It's versatile. It can add another 180,000 barrels per day for ethane, or it can handle 360,000 barrels per day of propane. Gives them options depending on market demand. Smart move.
Yeah, flexibility seems key. Any major new pipelines feeding in all this?
Yep. The Bahia pipeline. That's a 600,000 barrel per day wide grade pipe. Means it can handle various NGLs. Expected to start in Q4 this year. They think it'll come online around 50% full, maybe ramping to 60% in the first year.
Okay, steady ramp up there.
And another big one, Frac 14. That's a new NGL fractionator, separates the NGLs into usable products like ethane, propane, butane, also due in Q4. And that one, they expect it to come up completely full.
Completely full, right out of the gate. Again, speaks volumes about demand for that service.
Definitely.
So you put all this together, the existing network, these new projects. It sounds like they're building this incredibly integrated, almost indispensable system. How does that connectivity play out as a competitive advantage?
Hugely. They emphasize their connections, directly or indirectly tied into, get this, 100% of U.S. ethylene plants and 90% of refineries east of the Rockies.
Wow, that's market saturation.
It really is. And this whole downstream footprint, the Neches terminal, expanded LPG loading at their EHD facility, more ethylene export capacity at Morgan's Point, it's all designed to get them better access to global markets. They specifically mention ethylene export fees being attractive, charged in cents per pound.
Why is cents per pound better?
It's less tied to the commodity price itself, more stable, potentially higher margin revenue compared to just a volume fee, kind of insulates them a bit from price swings.
Clever. Okay, so that's the growth story. Massive investment, strong demand, deep integration. But you mentioned headwinds earlier. Let's circle back to those broader market challenges. How are they navigating those?
Right. So one big one they flagged, the LPG export market. Liquefied petroleum gas. It's getting increasingly competitive. And they said the impact is already evident. Spot terminal fees, the short-term rates have plummeted, down like 60% in a year, from maybe 10, 15 cents a gallon down to much lower levels.
60% drop. Ouch.
Yeah.
How does that hit their bottom line, especially if volumes are up? And what's the counter strategy?
Well, it did hit them. Even though their Q2 export volumes increased by 5 million barrels, the gross operating margin actually declined by $37 million. A big reason was recontracting an old 10-year deal at today's much lower market rates.
Oh, okay. Legacy contract rolling off.
Exactly. But their defense, it's twofold. One, focus on brownfield expansions, expanding existing sites, which is cheaper than building brand new when the economics for new builds simply don't work. And two, lock in volume. They expect their facilities to be full, pure and simple, mostly contracted like 85–90% through the end of the decade. So make up for lower per unit fees by moving more product. Volume over margin, essentially.
Makes sense. Use your scale and existing footprint. What about the geopolitical side? There was that comment about weaponizing U.S. energy exports. What was that about?
Yeah, they voiced some concern there. Said actions like that rarely hurt the intended target and can backfire, hurting our own industry more. They brought up what they called the BIS ethane incident, likely referring to some Bureau of Industry and Security action. Said it didn't directly hit Enterprise much because their customer base is so diverse globally. Vietnam, Thailand, India, Europe, Mexico, Brazil.
So they were insulated due to diversification, but was there a bigger ripple effect?
They argued it does compromise the U.S. brand for reliable supply. They even gave an example. A non-Chinese company apparently chose naphtha instead of U.S. ethane, specifically because of worries about reliability stemming from U.S. policy actions.
Ooh, that's a tangible impact. Not financial, but reputational. Affects future business potentially.
Exactly. It's about that perception of the U.S. as a steady, reliable energy partner. Policy consistency matters globally.
Crucial point. Okay, shifting gears slightly. What about other parts of their business, like octane enhancement for gasoline, MTBE?
Yeah, MTBE margins. They said they've normalized. They had some outsized earnings in past years, really high margins, but now things are back to more typical levels. Importantly, they stressed the business remains healthy. The lower margins aren't because demand is weak, but because there's new supply in the market, specifically more capacity out of China. It's turned MTBE from more of a regional thing into a global market.
So more competition, prices normalize.
Got it. Let's talk Permian again. There's been chatter about oil growth slowing down there next year. What's Enterprise's take?
They have a clear view. The Permian is going to get gassier for years to come.
Gassier, meaning more natural gas relative to oil.
Precisely. Their reasoning. The easiest and oilless locations, meaning the spots richest in oil, have for the most part been drilled up. So producers are hitting rock that has more gas. Plus, oil production naturally declines faster than gas production from wells.
Interesting. So even if oil plateaus a bit, the gas keeps coming, which is good for their gas infrastructure.
Exactly. That plays right into their strengths with all those new processing plants. And what about oil prices themselves? Given OPEC moves, geopolitical tensions easing a bit, are they pessimistic?
They're actually not as bearish as some folks. They acknowledged OPEC adding supply, maybe 2 million barrels a day incrementally over 6 months, and that the war premium faded after the Israel-Iran stuff calmed down. But they argue OPEC kept 2 million barrels off the market for 2 years. That created a massive hole in supply, so they don't see prices collapsing. They even think if prices dip into contango, where future prices are higher than spot prices, oil will just go into storage, which supports the price.
Okay, so a more balanced view on oil prices. And what about the producers in the Permian? Are they profitable enough to keep drilling?
That's key. Enterprise says Permian producers are extremely profitable right now. Why? Better natural gas prices locally, the gas basis has improved, and more pipelines to get gas out. Takeaway capacity is better, so they expect producers will stick to their plans. 3-5% growth. And they're hedging aggressively, locking in prices for 2025, 2026, even 2027.
Hedging that far out shows confidence.
Yeah, and they gave a specific example. Midland Basin producers scheduled to bring on 498 wells next year, up from 463 this year. So activity continues.
That's solid evidence against the slowdown narrative,
Yeah.
at least from their perspective. Any other gas opportunities popping up outside the Permian?
Yes, the Haynesville Shale, another major gas basin. They mentioned recontracting pipelines on their Acadian gas system there, and they're getting rates 2 to 3 times higher than historical levels.
Wow, 2 to 3 times higher.
Yeah, driven by increased drilling activity in the Haynesville thanks to currently favorable gas prices, so another strong spot for them.
Okay, it really sounds like a company firing on multiple cylinders, playing defense smartly, and capitalizing on opportunities. Let's pivot to capital allocation. How are they managing their investments and shareholder returns?
They're clearly being disciplined. Q2 total capital investment was $1.3 billion, but break that down. $1.2 billion was for those growth projects we discussed. Only $117 million was sustaining capital, just keeping the existing assets running smoothly.
Heavy focus on growth. What are the projections looking forward? Still planning big spending.
Yes, the plan holds. For all of 2025, they expect $4.0 to $4.5 billion in organic growth spending. Then for 2026, it stacks down a bit to $2.5 billion, and they already have about $2.2 billion committed for 2026 projects, so they have good visibility there. Sustaining capital for this year is pegged around $525 million.
Okay, substantial but defined investment plan. How's the balance sheet holding up under all this? Are they taking on too much debt?
Seems very manageable. Total debt is around $33.1 billion. But the key things are, the average life of that debt is really long, 18 years. The average interest cost is low, 4.7%. And crucially, 98% of it is fixed rate debt.
Fixed rate is huge in a rising rate environment.
Yeah.
Protects them from interest cost spikes.
Exactly. Very prudent. Their liquidity, cash on hand, and available credit is strong too, about $5.1 billion. And leverage, right on target. 3.1 times debt to EBITDA, basically right where they aim to be, 3 times, give or take a quarter turn.
Sounds financially solid. What about returning cash to investors beyond the distribution? Buybacks.
They are doing buybacks, bought back about 3.6 million units in Q2 for $110 million. That brings their total under the current $2 billion program up to $1.3 billion used. Their approach is opportunistic. buy when they think the price is attractive. They did signal maybe a larger opportunity for buybacks in 2026 as more free cash flow rolls in from those big projects finishing up.
Makes sense. More cash, more options. And there's a really interesting point about employees owning units, right?
Yeah, this is pretty unique, I think. Almost half their employees participate in the company's unit purchase plan. And get this, employees, retirees, and their families collectively own over 40 million EPD units. That's almost 2% of all the units outstanding.
2%. Owned by employees and retirees.
Yep, makes them the second largest unitholder overall. It's not just a nice story, it means employees have serious skin in the game. Their interests are deeply aligned with other investors, fosters long-term thinking, stability.
That's genuinely powerful. Creates a really strong internal alignment. So adding it all up, distributions plus buybacks, what was the total return to investors over the last year?
For the 12 months ending June 30th, 2025, total capital return was $4.9 billion. That worked out to a payout ratio of 57% of their adjusted CFFO. So returning a significant majority of their operating cash flow to unitholders.
Healthy payout. Okay, looking even further ahead, where do they see the next wave of growth? Acquisitions? Or sticking to organic?
They seem focused on organic growth and low-cost expansions within their existing massive footprint, leveraging what they already have. They specifically mention not really looking at passive equity investments in things like LNG export terminals. They see a big step up in discretionary free cash flow coming in 2026 and 2027 as all these projects start generating serious cash. And that extra cash likely means increased capital returns for investors down the road.
So doubling down on their core system, maximizing efficiency, and planning to return more cash. That seems to be the strategy.
That sums it up well. We've really seen how a major energy infrastructure player like Enterprise is doing more than just coping. They're actively thriving. Despite market complexities, geopolitical stuff, it comes down to smart, disciplined investments, running their operations incredibly efficiently, and having a clear plan for their money, all built on a rock-solid balance sheet.
Yeah, and this kind of deep dive, it really shows you how these fundamental energy services companies are adapting constantly. And their adaptations, they affect everything from the price you pay for goods to global political relationships. Understanding this helps grasp that bigger energy picture.
Absolutely. And maybe here's something to think about as we wrap up. We live in this super interconnected, sometimes pretty volatile world, right? How is the whole idea of energy security going to keep changing? And what part will this kind of adaptable, integrated energy infrastructure, the pipes, the terminals, the storage we talked about today,
Yeah.
play in shaping that future? It's not really just about pipelines anymore, is it? It's about the fundamental stability of trade, of supply chains, all relying on these reliable energy flows. Something to chew on.